Okay, so this is a three-part series. Basically, I'm gonna talk about what I'm currently holding in my portfolio, some of the reasons, and what I might do with it in the future. So feel free to ask questions if you need more specific answers that I didn't cover in this video. Let's try to have this under 4 minutes. Firstly, I have positions in iShares MSCI Japan ETF. Now, for those that don't know, an ETF is like a mutual fund that is traded like stocks. Yeah. I bought this back in November 2017. It holds right now it's 21% of my portfolio, and the reason I bought this was at the time the Japanese yen was weak against the US dollar, so there was a bargain there, and I saw the Japanese economy slowing picking up to its prior glory. So yeah, I bought some of that just to get away from the US market in case things don't go my way. Okay, secondly, iShares MSCI China ETF. I bought this back in January 23rd, so it holds 8%, close to 9 right now, so it's like 8.6. Anyways, I bought it because China is a market that is still rapidly growing compared to other economies. It's projected to have 6% growth over the year, while the US, if everything goes well, might have 3. So yeah, especially the big companies, it's definitely exposure that I want to have. Okay, next, JP Morgan Chase. It holds 9% of my portfolio, and I bought this back in October 13, 2017. Okay, so bank stocks with rising interest rate and the tax cut, it will be very beneficial to them, and JP Morgan has solid balance sheet. I like how Jamie Dimon leads the company. So, yep, I bought quite a bit of it. Although I might want to reduce my positions in it because 9% is a bit much. I think I might buy other bank stocks like Bank of America or Citigroup, but we'll see after the next quarter. Okay, Wells Fargo, I bought this back in February 24th, which is when I first started. It's now 6% of my portfolio. So despite all the fraudulent accounts and litigation that's brought on the bank, I still think that they handle it well. It's very transparent, although not perfectly. Kind of disappointed that it happened in the first place, but they're making effort to repair their brand. So I really like that, and it's a bank stock, so profits are expected to soar with the tax cut and rising interest rates. Okay, Facebook. Facebook is a company that I bought in March 29th. 2017, so it's last year. It's currently at 6% of my portfolio. So as a millennial, I like Facebook. I like how they design their platform, how all the advertisement, it's really spot on to my own preferences, especially on Instagram. I like what they did with it there. Although I would like the feeds to be in a chronological order, like most recent feed first, but whatever. It's a good company to have. Zuckerberg is on point with the long-term growth of the company, which I really love him focusing on. So yep, more of Facebook. And lastly, 3M. 3M is a manufacturing company, a large one in the US. So they specialize in a lot of safety industrial products, which is very diversified. They have, being a manufacturing company, I just wanted exposure to the industrial sector. So it's a solid company with solid growth, dividends, sales. Yeah, it has. I bought this back in November 1st, 2017, and it is 5% of my portfolio. So, with the tax cuts, it's sure to increase in profits. But with the recent policy on tariffs and unclear whether or not there will be a trade war, the stock might fluctuate a bit. But overall, it's a good company to have. So. That's it for part 1. If you have any specific questions that you want to ask, feel free to comment or DM me, whichever you're comfortable with. Thank you.